Tesla stock had a surprisingly strong day today. We talked about this in the last video. There's really two reasons for this. Number one, China is now allowing Tesla to test FSD in the country, potentially paving the way for a rollout of FSD more broadly in China and what could be robotaxis. Next up, we did have just further digestion of Elon Musk's compensation package passing last week. On Friday, you've seen the markets that were super weak. I mean, the average stock got decimated on Friday, and Tesla was included in that. A little bit of a buy the rumor, sell the news event also took place on Friday. But today, investors woke up and realized, hey, that was massively positive for Tesla stock. And as I said before, Tesla's shareholder meeting, and what I said after is this: Elon's compensation package getting reinstated is going to be a positive catalyst for many months to come, and it could make Tesla trade better than what we've seen over the last couple of months, meaning good news may actually start to affect Tesla as good news. We've seen a lot of positive news over the past couple of months that has done nothing to help Tesla's stock go higher. Now, tomorrow we will also have very important data for markets that, could shake things up quite a bit. And I want to really start off this video with that because of how important it could be following what we've seen today. And again, as I've said recently, markets are not that great, right? If you're in your top 10 biggest names out there, awesome. You've done okay. You've done well. Other than that, the average stock has not done well. Okay, let's acknowledge that. When you have the percent of stocks trading above their 50-day moving average at 38%, that's not great. You started off 2023 at 86%. 86% of stocks were trading above their 50-day moving average then. Take a look at the S&P. What's happened ever since December? I mean, come on. You are up, 17.5% since December or so? And you only have 38% of stocks trading above their 50-day moving average. That's not a good number. It's not. And we'll talk about this a little bit more throughout this video, but that's why tomorrow could be so important for markets, because you will get retail sales month over month. Now, last month came in at 0%. You're expecting 0.2%. So if you get a negative number here, then you're going to be looking at an actual decline of retail sales. Because look at it like this. If you get, let's say, a 0.5 number for last month, theoretically, right? It came in at 0%, but let's say last month was 0.5%. And then you get a negative 0.3% for the next month. Well, wait, that's actually still a positive number, because if last month was 0.5% and the next month is negative 0.3% on a month-over-month basis, that's still fine. That's still good. Well, if you're at 0% and you get a negative number, then you're actually seeing negative growth. That could be a little bit problematic for our markets. And after all, we have not seen a negative month-over-month number in a long time, right? January was negative 1.1%, coming off of December's positive 0.4%. People said, hey, that's after Christmas drop off in spending. That's common. Well, last month was 0%. If it comes in negative, yeah, you might have a big problem on our hands in the markets, because the reason stocks have been not doing well under the surface, and this is a very historic moment in time, you want to pay very close attention to this video, is because parts of the markets are priced for a recession. Recession here, recession there, consumer discretionary, even consumer staples to a certain degree, priced for recession. But when you look at big tech, when you look at Nvidia, Microsoft, Google, Amazon, all of those guys, even Apple, that is consumer cyclical in nature, they're not priced for a recession. So there is a big discrepancy of what's going on with the top percent of stocks and the rest of stocks. And that's why the markets have been so bad. And over the last couple of weeks, you have seen a lot of selling in the bottom 95% of markets, virtually all of the markets besides big tech. And it hasn't made its way into big tech just yet. But if retail sales come in bad tomorrow, then markets might start to generally ask the question, are we actually going into recession? Is the Fed going to make a mistake? And with the markets this overextended, that will be very important. I mean, just look at this. You have the fear and greed index over on CNN Business at 44, which is still in fear. But yet you have the S&P with an RSI of 77 hitting a new all-time high. And you have the NASDAQ, which is even more overextended, with an RSI of 81.65 hitting a new all-time high. Like, you're never going to see that ever again in your investment lifetime, most likely. That's just showing the huge discrepancy, the difference between what average stocks are doing and what the S&P and the NASDAQ on a headline basis are doing. That's why ultimately I think retail sales will be a very important data point coming out tomorrow. You will also get industrial production month over month, expecting 0.2%. Last month was 0%. Same thing there. If you get a negative number, then that's actually going to be negative for the last 2 months. And that's not a great sign for economic activity. Now, you will also get business inventories month over month. Last month was negative 0.1%. You're expecting positive 0.2%. Indeed, actually, the more positive this number is, the worse off, because typically you want to keep inventories low. That tends to be good for your business. That tends to be good for GDP. So the higher that business inventory number is, the lower GDP estimates might come in. And on that note, the Atlanta Fed GDP Now tracker is currently estimating about 3.1% GDP for Q2. Wall Street is currently sitting at about 2.2% GDP for Q2 as their estimate. The bottom estimate at about 1.5%, the high end estimate at about 3%. Tomorrow morning, we will get a new update from the Atlanta Fed GDP Now tracker. So depending how retail sales, business inventories, all of this data comes out tomorrow morning, it will affect your GDP estimates for Q2. And that's another reason why tomorrow will be important. Beyond that, you will get Fed speakers throughout the day tomorrow. Fed Barkin will speak at 10 o'clock in the morning. Fed Collins at 11:40 a.m., and this is all Eastern Standard Time. Fed Kugler and Fed Logan speak at 1 p.m. tomorrow. You do have a 20-year bond auction at 1 p.m. tomorrow as well. The last yield we had was 4.635%. Anything lower than that, likely seen as good news. Anything higher than that, likely seen as bad news. And then you do have Fed Mausoleum that speaks at 1:20 p.m. Fed Goolsbee speaks at 2 p.m. And then you have net long TIC flows, expecting those around 69 billion. So all of this that we get tomorrow will be important. And actually tomorrow is one of the bigger days for data that we will get this week, until you do get Friday's PMI numbers. So if you are going to get a large corrective move, tomorrow could be the moment for that. Ryan Dietrich on X said, did anyone else hear about the divergence under the surface of the S&P 500? He says, I see it also, but given everyone sees it, makes you wonder if internals play catch up versus break down. And if you are a bull right now, you have to be betting on small caps, medium caps, interest rate sensitive stocks catching up to the S&P and the NASDAQ and starting to really rip higher from here. If not, then you will likely get a catch down. Now, what different things will cause a catch up to happen with small caps, interest rate sensitive, medium caps, just average stocks? Well, one, inflation came down lower than expected. That's good. You need the economy to hold up is really it. If the economic data starts to turn down and starts to look worse, then you will see a catch down in the markets, and that will be negative for the S&P and the NASDAQ. So right now, if you're bullish, you gotta hope the economic data holds up, because the markets, they don't have confidence in the Fed that the Fed's going to actually prevent a Fed error. Last week, the Fed showed their hand. Last week, the Fed confirmed that they are waiting for unexpected weakening in the economy, in the labor market, to start cutting rates. And that's not a good recipe for stocks. Bar chart here over on X, it says still in fear with a laughing, crying emoji. This is in regards to what I shared, this ENN Fear and Greed Index. Sitting in fear territory. At the same time, stocks are ripping to new all-time highs. Meet Kevin over on X also acknowledges that 34% of all the gains in the S&P 500 this year are solely due to one stock. That stock is Nvidia. Now, what's also interesting about Nvidia is what tends to happen, or has tended to happen over the past couple of years, is anytime you get a stock split, the stock tends to rally into the split and then sell off after the split. And what's happened with Nvidia is you rallied into the split, you have rallied after the split, and you have not seen a material sell-off yet. Today, Nvidia is down about 0.5%, but that's really not a material sell-off when Nvidia has, you know, been doing so well. That's not your post stock split typical sell-off that is around 10 to 12%. So it is possible that Nvidia could start to give up a little bit here, and that will have an outsized effect on our markets, especially if it is met with bad economic data or bad news. You could see markets fall aggressively from here if we actually do start to catch a downside move. I don't say this to keep you on the sidelines, to keep you out of stocks. I'm fully invested in this market, but I'm becoming a little bit more defensive, raising as much cash as possible, and ultimately I've bought a couple puts on our markets. And I think that's probably the best strategy at this point. I think there can be more upside, but I think it has to come from the internals of our markets, the Russells of our markets, the Teslas of our markets, for that matter. Seth Golden on X says it looks like a big bear fund was forced to capitulate with advanced decline lines that have flipped positive on the day today, advancing stocks at 1,410 and declining stocks at 1,361. Fed Harker today said we need to be cautious, and they want several more months of data, just reinstating yet again the Fed is going to make an error. Zero Hedge on X says the mother of all mass layoffs is coming. You can see this is a corporate transcripts of the mentions of operational efficiency. When you get these mentions that rise, you tend to see the unemployment rate rise as well. And notably, you've seen from 2006 until 2008, this term operational efficiency was rising, but ever since really 2022, this has really started to rise and now is hitting a brand new high that you have not seen since at minimum 2005 as per this chart. And tech relative to the S&P 500 has now hit new highs. The ratio is 10% higher than even the peak of the dot-com bubble. Again, just showing the discrepancy between big tech doing all of the work and the rest of the markets doing basically nothing for years now. Ryan Dietrich writes, with a green close today, that'll be 30 all-time highs for the S&P 500 in 2024. This happened 20 other times, and that finished the year green each time, not all that surprising, with an average return of 19.6% and a median return of 19.5%. Fed Harker said, if my economic forecast plays out, I think one rate cut would be appropriate by year's end. And it looks like JP Morgan has started to capitulate as well. They say, quote, today, while we had thought the market was setting up for a pullback based upon the price action during earnings season, narrowing breadth, reduced HF positioning, and the potential for markets to take some profits given the almost 32% gain in the S&P 500 since the bull run began in October of 2023, 38.6% for the NASDAQ, this has not come to fruition, and the near-term market setup points to another leg higher being more probable than a pullback. The macro data should support this hypothesis into a seasonally strong July. One user commented on that post and says, capitulation comes before a fall. Carl from CNBC that posted this on X posted this meme and responded and said, interesting. JP Morgan's Marko Kolanovic, that has been bearish for years, says nope, We don't see it, and a 20% correction is base case probability near term, growth to weaken, and a better entry point ahead. The actual note says our cautious stance has been based on our view that there is no re-rating upside, and that any upside had to therefore come from earnings growth, which we see being insufficient to take on equity risk, even under the best case scenario assumptions. For equities to avoid a 20% plus correction, you have to believe that tech will become a much more meaningful driver of growth for the broad economy in short order. While we believe tech will continue to be the key driver of economic growth for years to come, we don't think its impact on corporate P&Ls across the board will be that profound so suddenly. And so we remain cautious here, expecting economic growth to weaken, equities to correct, and investors to find a better entry point. Jeroen Blockland on X says the real estate recession in China shows no signs of abating. Property investment declined more than 10% from a year ago. May mark the 26th consecutive month in which property investment declined. Home prices have fallen for 34 straight months, and the pace of depreciation is increasing. Home values dropped by 1% in May, the biggest monthly decline on record. And from my perspective, what really drove the markets higher today in large part is just a simple short squeeze. If you take a look at the short interest on the SPY, this is the ETF for the S&P 500, it is sitting at 9%. That is down from 16.03% 12 months ago, down 44%. I mean, you have seen a constant flow of shorts covering even over the past 2 weeks. The short interest was 10.09%. That is down 11% over the past 7 days. Pretty much the same thing. Short interest was 9.98%, down about 10%. That means 1/10 of shorts covered on short positions just in the past 7 days. What you can actually see today, which is interesting, is some people may be trying to call a top with return shares, aka covered shares, of 2.27 million today. Borrowed shares, or shares that were sold short, of 5.15 million. That means on net today, you had about 3 million shares that were sold short in the S&P 500. So it certainly looks like some people may be trying to call a top here. Now, that is obviously a dangerous game, and, well, I think NVIDIA decides that fate for the markets at this point. If you take a look at option activity expiring by this Friday, you do have the calls picking up a little bit for open interest. Open interest on the call side currently at 45.23%. Put open interest at 54.77%. Volume today was a little bit lower than that. Call volume at 40.28%. Put volume at 59.72% today. Here today, positive order value in Tesla option activity from big money was 92%. So a vast majority of the big trades placed by big money today were positive. You had 7 different trades that popped up on the scanner worth $5.32 million. Now, if you take a look at this Friday's expiration for Tesla, 68.52% of the options that are currently held in people's brokerage accounts, Tesla options, are calls. 31.5% are puts. So it does seem like people are betting for an end of the week rally for Tesla. Now, into the end of the day today, Tesla stock did go higher, ended up closing the day up 5.31%. Again, finding rejection around that 188 level. At one point, you were almost 189. But you did end up closing at $187.47 per share, finding rejection at that 188 level. Now, for the downside, you want to watch this trend line here that I've had marked on this chart for a long time now, which is around that 183, 182 level or so. I think tomorrow it's possible we could retest that if indeed the retail sales number comes in lower than expected. That's going to be seen as bad news by the markets, and that would be the level that I would be watching. But again, as I said in the last video, it is a positive sign. You bounced so strong off that 100-day moving average. A lot of buy orders came in at this level, and I think that will help keep Tesla stock elevated. Now, heading into July 2nd, I'm expecting a very good delivery number that will likely give Tesla that next leg higher heading into Tesla's earnings, which will be around July 20th or the 21st, 23rd, around that area. Now, if the markets decline during that period of time, well, maybe you don't get the strongest rally for Tesla. So we'll have to see. I think the broader markets can have a big impact on how Tesla stock trades here. Tesla on the RSI is sitting at 59.71, so definitely more room to run to the upside there. And the MACD line at 1.57 positive, which is good. Signal line at 0.92. MACD line above the signal line is as well a short-term positive indicator. So let me know what you think about all of this information down below in the comment section. Again, I still want to be defensive here. I'm not buying this as a super strong market because statistically it's not, and I've never seen anything like this where you have so many stocks that are doing bad and just a handful, literally a handful of stocks that are driving all of the gains in our markets. That just normally does not lead to a good outcome. And I find it hard to wrap my brain around a catch up with small cap stocks and average stocks starting to do very well and outperforming big tech to give you that catch up when it looks like the economy's weakening, unemployment rates likely to continue to rise here, and the Fed's going to make an error. That's not the most ideal situation to be in. But hey, I've been wrong before. Maybe I'll be wrong again. We'll have to wait and see. I think time will tell, and I think tomorrow will be a very big event. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day. And oh, by the way, if you guys want to come trade with us live in real time, check out that link down below in the description of this video. We're fully invested. We're ready for whatever, but we do have some hedges out there to protect the long-term portfolios. So boss man wants his attention, so I'm gonna get on that. It's like 95 degrees here in Michigan today. We are going to go swimming. See if I can teach him how to swim already. That would be pretty cool. But nonetheless, you guys enjoy the rest of your day, and I will see you in the next one.